Oh, sorry. I was wondering where everyone was. Okay. All right. We're back in business here. Hello, everyone. David Johnson, how are you? How are you? I think I'm right. Okay. Everybody can hear me? Yeah. Okay. This is important because I just got this. Basically, let's talk about inflation because the Fed just reported some interesting information about their recent discussion. The papers. Federal Reserve officials warn progress towards inflation goal will be uneven. Okay, that means that, and I think I told that to my subscribers, to my members this morning during our live. You got to watch out for inflation. This economy is great, but do you really need to lower inflation? To lower rates? That's a and this chart that I'm going to talking about. Let me make it a little bit larger for you. Is very important because if some of you remember the 70s, it basically mimics. There's two charts on top of each other, two lines on top of each other, and you see what's happening right now and what happened then, and you could see we're following verbatim what's going on. So we're going to start with this chart because we're in big. I mean, there are ways to take advantage of this as usual, and I'll talk to my members about that. But everyone else, you need to be aware that you do not lower rates when you have inflation coming in. And right now, obviously, they don't really want to talk about it too much because the new Fed chair that's coming, obviously, wants lower rates. I mean, the government wants lower rates. So this is deja vu all over again in 1970, believe it or not. Okay, do this. It should be interesting because I think that this is not gonna be good for the stock market, obviously. Imagine if this new Fed decide to raise rates. I mean, they're not even talking about lowering rates anymore. But suppose he says, you know what, we may need to raise the rates. What do you think the government is going to do to him? Okay? All right, so let's start. Hopefully you learned a thing or two. So as we watch inflation cooling down, or as we watch the first mountain before a second one forms, history has shown us something important. Inflation does not always fall in a straight line. Sometimes it comes in waves, and sometimes the second wave is worse than the first. As you recall, we had one not too long ago. So on your screen, you see on the screen, you're seeing a interesting chart. And it's not a big dramatic headline, but it basically states that will we see a repeat of 2021 and of the and the 70s. So it's a structural comparison. It's a structural comparison of what happened then and what I believe is about to happen. And when we combine this chart with a recent Financial Times reporting that, they basically stated that Federal Reserve officials warn progress toward the inflation goal will be uneven, which is a subliminal message for don't expect any rate cut soon. And also the article on that the U.S. markets and the economy are entering uncharted territory, quote unquote, we begin to see something deeper, something more serious. So, how to read this chart? This chart basically compares two inflation periods. The modern period, roughly 2014 through today, and the 1966 to 1982 period. You'll see two lines. The green lines represent recent core CPI. That's inflation excluding food and energy. The blue line represents inflation from the 1974 to 1982. Now, here's something important. The chart uses two vertical axes. The left axis is for today's data, and the right axis is for the data from the 70s. So why am I using two scales? Because inflation in the 70s went much higher, into double digits, than today. So if we use one scale, the modern line would look very tiny. So these charts align patterns rather than raw levels. It's comparing shape, not exact numbers. And that shape is what matters. Look at the timeline at the bottom. You'll see the modern period laid over the older period. The idea is to show how the structure of inflation may be similar. Now notice the labels in the middle of the chart. The first inflation mountain, kind of in the middle, and that first inflation mountain occurred in, as you look at the lower, in 1974 and also in 2022. Need I remind you what happened in 2022 with COVID and the money that was spent and a huge amount of inflation that ensued when the market was, the economy was reopened again. And at that time, the Fed didn't really act that fast because they thought this would be a transitory inflation, which it was not. And then later on, we have a second inflation mountain, and that phrase is key. So inflation rarely moves smoothly downward. Instead, it often behaves like this. It rises sharply, it peaks, it falls, and it stabilizes, and sometimes it rises again. That rise-fall pattern forms what looks like mountains. In the 70s, there were two major mountains. The first one came down. Policymakers. That was the Nixon era, and at that time, his Fed chair, which is now considered the worst Fed chair in history, Arthur Burns, look it up. And policymakers thought that they had won. Then the second one arrived, and that one was worse, as you could see. Now look at the green line. Let's do this inflation. We saw a surge after 2010, 2020, and 2021. We peaked and inflation cooled. And now the big question is this the end? Or is this just a valley before another climb? So why does the 70s matter so much? Well, in the 70s, there were not just high inflation. It was unstable inflation. Policymakers would tighten policy. I mean, I don't have to remind you what happened all last year with the government. For right or wrong reason, decided that they needed lower and lower and lower rates, which they got. So policymakers would tighten policy and then inflation would fall. Then they would ease too early and inflation would return. That damaged credibility, and there's the same theme today, right? We're talking about is a Fed independent, and what I want for my subscribers and my members is I want you to understand what's happening before it happens, before you get hit. And every day in the morning, I talk to my members and explain to them, okay, this is what I'm doing. And one of the topics, obviously, that I started this morning, kind of started last week a little bit, is inflation. So at that time, markets suffered, bond yields soared, stock valuation compressed. The lesson, inflation can retreat and then return. And once expectations shift, it becomes harder to control. So what is the Financial Times also saying? Well, let's connect what they're saying. And the Financial Times recently quoted Federal Reserve officials saying progress toward the inflation goal will be uneven. That word matters, right? Uneven means not smooth, not steady, not guaranteed. It means inflation may stall, it may bounce, it may refuse to go quietly to 2%. In another article, the Financial Times also described the economy and markets as heading into quote-unquote uncharted territory. That is strong language. Central bankers and serious financial journalists do not use those words lightly. Uncharted territory suggests high debt levels, elevated asset prices, tight monetary policy, political uncertainty, and structural global shifts. That is not a normal cycle. That's a complex, very complex cycle. So why would progress be uneven? Right? So let's break this down. Why might inflation not fall smoothly? First of all, wages. Wage growth, if you work, has been sticky. Second, housing cost, shelter inflation, fiscal spending. The primary culprit in creating inflation is the government. Government deficits remain large, and of course, supply chains. They are more stable than in 2021, but global trade is fragmenting. And then, of course, you've got energy and commodities. These can turn quickly. 2 ships in the Middle East right now. If we start the bombing, oil prices are going to go up. Put all of that together and you get the bumpy road, not the straight line down. Now, could there be a second mountain? Well, let's look again at the chart, right? So the 70s show a second surge after inflation had cooled. That second surge was driven by oil shocks, loose policy, rising expectation, right? Now, loose policy means, believe it or not, Nixon got Arthur Burns to lower the rates at that time when there was a huge amount of inflation caused by the Vietnam War because the U.S. was spending a lot of money on weaponry. So today we don't have the same oil shock dynamic, but we have geopolitical tension, massive debt, fiscal expansion, and structural labor shortages. The ingredients are different, but the risk of persistence is real. So what are the market implications? Well, if inflation progress is uneven, markets react. Stocks depend on predictable rates. Bonds depend on stable inflation expectations. If inflation stalls above the target of 2%, the Fed keeps policy tight longer. Remember, we are almost 3% for the past year. They can't bring it down. That pressures valuation. The higher the rates, the lower the stock market. If inflation reaccelerates, policy could tighten again. That means that the Fed is going to say, sorry, I'm going to have to raise rates. You know what this is going to do to the stock market? That creates volatility. Gold often benefits from inflation uncertainty rises. Risk assets struggle when policy credibility is questioned. So you're in the middle of a psychology trap. Investors love the phrase, inflation is coming down. But markets price the future. If inflation gets stuck above 2%, that changes everything. The danger is not inflation itself. The danger is assuming it's fully defeated. So why is this cycle different? Well, because this is not the 70s. We have the highest public debt levels in decades ever. As the Fed chair says, it is manageable, but it is not sustainable. Asset valuation still elevated, aging demographics, political polarization, and global supply chain restructuring. So we're combining modern financial leverage with old inflation pressure. This is a new ground. That is what uncharted territory means. So instead of predicting one outcome, think in scenarios, okay? 1, inflation falls steadily to 2%. Rates fall, markets rally. Scenario 2, inflation stalls at 3%, which is what it is now. Rates stay higher for longer. In fact, they're already saying we may not want to lower rates any lower than this. Markets move sideways. And scenario 3, inflation rises again and policy tightens. Stock market drops. And with my members, I am starting to develop a strategy for myself as well in order for me to take advantage of this situation in case the markets start dropping, and hopefully educate my members in the process. So in closing, history does not copy exactly, but it often rhymes. The 70s teaches us that inflation can come in waves. The Financial Times reporting tells us policymakers know progress will not be smooth. And when officials use phrases like uneven and uncharted territory, we should listen, because markets do not collapse from various risks. They collapse from underestimated ones. If this analysis helps you to see the structure behind the headlines, I want you to subscribe. I want you to become a member if you want to learn more about it. And if you want to understand how rare events reshape the financial system, check out the Black Swan book that I will tag on this video. So stay disciplined and stay aware. Can't we see a scenario where inflation does reemerge, but for political reasons, rates go unchanged or even lower? That's exactly what's going to happen. Right? I mean, the new guy, Walsh, used to be a hawk. He used to say, I believe in higher rates to slow the economy down. But there was no way he's going to get that job if he said that. So now he's saying, no, what I want lower rates. And they said, well, why? The economy is growing fine. He says, yeah, but that's because of AI. And AI is going to be very efficient. There's going to be lots of rationalization. Don't you see all the people that we're firing? Right? Because of AI. So even though we're growing, we're not going to spend too much money. How do you know? Well, that's what I'm seeing. Why are you going to, but don't you want to see the data? I'm not Jerome Powell. I'm my own person, and I am not data dependent like the other guy was. We better get it right. Or he just said it to get the job, and once he's in the job, he's going to say, Mr. President, I'm sorry, but I can't lower the rates. We're still at 3%. Do you know what the administration is going to do? I'll let you guess. So be very careful. Be aware of this. It's not going down. There's a huge amount of growth. And don't forget, we're not talking. And the reason you're seeing that growth, I will tell you what it is. They start lowering the rates in September 2024. And they've been lowering it and lowering it and lowering it. Rates, it takes a year and a half before you see any impact. September 2024, right? A year is September 2025. Add 6 months to that. 9 and 3 is 12. 12 and 2 is 3. We're just about now seeing the impact of those lower rates from September 2024. So that means that you're going to see the impact of lower rates now. It's too late, even if you don't lower rates. And they know, I know it, but they know that too. They know that that wave is coming. All those low rates, now they're going to hit the market, the economy. And that's where you're going to see higher and higher growth, which is fantastic, right? But be careful. You got to manage inflation. And of course, the stock market and everything else that goes with it, and geopolitical situation and everything else. So everything else is going to come at the same time if it's not managed properly. And of course, as you know, there is going to be midterm election. What do you think these people are going to do when it comes to you're not going to raise rates when I'm trying to be elected? It's going to be a worse timing, let me tell you. Watch for gold and silver. In fact, silver is moving up already. Well, we have to talk about Bitcoin again, I think. The reason we need to talk about Bitcoin is because it's becoming interesting. Should we worry about Bitcoin? Is it going to go down to zero? Michael Berry says that the Bitcoin is going to be worth zero soon. You have to understand that this Bitcoin business is a little more complicated, and you need to understand it. Because if you don't, you're going to be taken to the cleaner. So take a look at this chart. This one. Look at this. Let's try to understand what happens next with Bitcoin. Okay, this is a bit, just because it doesn't really have a functional value doesn't mean it will go. Of course not. Of course not. I mean, you just because you don't understand it, it doesn't mean it's not worth anything. You might not understand Bitcoin or cryptocurrency and all that. But where in the world can you move that much money that quickly and that safely? Because it is safe at the end of the day. Gold, you're going to move. Do you know what $1 billion worth of gold is? You can't do it. Silver, it's impossible. Silver is almost impossible to move. But Bitcoin can be moved very quickly. Of course, you may not understand how it moves and where the Bitcoin comes from and what is Bitcoin mining and all these questions. But that's the future of currency. China is completely into it. And the US slowly is moving. It's a little more taking slower because the previous administration wasn't into it, but it is, let's put it this way. If you had, there's an ETF that I'm following for my members, and I think it's up. Well, it's down. That one is down 40%. Okay. But maybe it's an opportunity. Okay. Let's take a look at this one. Bitcoin's I'm going to show you every 60% crash since 2013. Because I think, unfortunately, most investors react. And I could see the mayhem out there. Remember this video, we'll come back to it, or this live, and you'll see what really happened in the end. Let us talk about volatility. Not small volatility, but let's talk about, not 5 to 10% pullback. Let's talk about 60% drawdowns, which is drawdown is basically how much you draw down from the top. And I want you to take a look at this chart. So by the end of the video, you'll understand exactly what Bitcoin does in every cycle and what this might mean for the cycle right now. And again, if you appreciate this kind of deep chart-driven breakdown, I want you to subscribe and I want you to give us a like. It does help grow the community. So if you want, and also I'm going to be tagging a great book as well at the end of this video. So I have to read this chart. Before, we need first to understand what we're looking at. At the bottom on the horizontal axis, we have time. This runs roughly from 2012 on the left all the way to February 17, 2026 on the right. And then you have the vertical axis and you have the price. Simple as that. But this is a log scale again. So that means that each step higher represents a multiple increase, not a flat dollar move. Okay. So when the price moves from 100 to 1,000, it's shown similarly to a move from 10,000 to 100,000. So basically it allows us to see percentage growth clearly over a long period of time. Now look at the shaded red vertical zones. Each red shaded region marks a major drawdown. Defined here as a drop of 60% or more from peak to bottom. And inside those red zones, you'll see labels like minus 70, minus 91%, those little boxes, right? Red, 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 all over. And those are the peak to drop losses. Then, after each major decline, you'll see a green label. Those green numbers show the percentage gains from the bottom of the crash to the next major peak. So this chart shows something simple but powerful. It shows basically that every massive crash in Bitcoin history has been followed by a massive recovery. But, and this is critical, the size of the recovery is changing. The size of the recovery is changing. And that's what we're going to analyze very carefully. So look at this left side of the chart. Bitcoin starts near just a few dollars. This is in 2013 to 2014. Right? So we're really, really in its infancy. This is a beginning where, Bitcoin really starts to do well, right? 2013, right? We were like less than $10, and then we start to take off. And Bitcoin starts just near a few dollars, and in 2013 it explodes upward. Then we get our first major crash, minus 70%. Then we get another deep crash, minus 91%. You see the two square on the left? Then it's almost total destruction, minus 91%. Now, of course, it doesn't drop back down because it's a log scale, okay? But 91%. So if you invested $10,000, you were left with $900. Most people would have walked away forever. But then look at the green number that follows, plus 1,710%. I had a discussion with one of my algo trader friend recently, and basically he says, be careful out there. Because the market is controlled or governed or monitored or ruled by institutions, and the little guy has to be very careful. So then after the next crash, another 500%. This was the hyper-growth phase. Small asset, small market cap, high risk, huge upside. That is what early adoption looks like. Of course, you're buying when everybody else is selling. Extreme gains, but extreme pain. Then we have the 2017 boom and the 2018 collapse. Now move your eyes to 2017. We're kind of in the middle here, almost, and we're starting to move up again. You see a vertical run. Bitcoin goes from under $1,000 to nearly $20,000. Then we get another red zone, minus 83%. This is the 2018 crypto winter. Media declare Bitcoin dead. I don't know what Michael Berry was saying at that time. It's like Michael saying today this thing is going to be worth zero. Institutions ignored it. And of course, retail vanished because retail doesn't understand Bitcoin. Can't even see what it looks like, can't hold it. So then what happened? Plus 1,274%. But notice something important. The rebounds are still large, but smaller than earlier cycle. The early cycle rebounds were 1,000% plus. Now we're talking, between 300 and 200, 1,200%. It's still huge, but it's compressing. And that matters because then we have the 2021 peak and the 2022, 2023 collapse. Now look at 2021. Bitcoin reaches roughly $69,000. Remember that number? In fact, that's where we are today. Then we enter another red zone, minus 77%. This one was different because this time institutions were involved, leverage was extreme, derivatives were everywhere, and crypto companies were heavily interconnected. This wasn't just a retail crash, this was systemic, and we saw exchange failures, lending collapses, liquidity crunches, and price fell hard. Now, here where things get interesting. Look at the rebound from that bottom, plus 691%. Right, we are towards the right now, the last green square. 600, and compare that to the earlier cycle, 1,700, 1,200, 500. Now we're under 700. Each cycle, now remember, this is still 700%, okay? 691. Each cycle's rebound is shrinking. That tells you something very important. Bitcoin is maturing. And the current situation as of February 17, 2026, minus 46%. That's what the box says. Current minus 46%, February 17, 2026. That is critical. We're not currently in a 60% drawdown. Historically has experienced repeated 60%, but we are at 46, minus 46. That means that if history repeats itself, the cycle may not be fully complete. And that doesn't mean it must crash another 15%. But historically, major resets have gone deeper. That's just the data. So the pattern is volatility compression. Here's what this entire chart tells me, that one, massive drawdowns are normal in Bitcoin. So you shouldn't throw the baby with the bathwater. 2, recoveries follows. 3, each recovery is smaller than the last in percentage term. That's why it's important to know to get the peak, to get the bottom. And volatility is compressing over time. That is what happens when an asset grows. The market cap is larger. More capital is required to move the price. Speculation becomes less explosive. The asset slowly transitions from experimental rocket to high volatility macro asset. That is maturation, basically. So what does this mean for investors? If you're holding Bitcoin, you must understand one thing. 60% drawdown, not an accident. They are not structural. They have repeated many times. But yet, prices have gone up. So that's the paradox. You have huge amount of volatility with long-term growth. But every cycle teaches the same lesson. The largest gains happen after maximum fears, after deep drawdowns, when most participants have quit. But those gains require surviving the crash. Most investors cannot handle 70%. They will panic and sell. They will lose conviction. They will exit at the bottom and then watch the rebound without them. That chart is not about price. Again, it's about psychology. And that's what I teach my members. Psychology, education, understanding, so that when you look at risk management, you get comfort from it. Look at the green percentages. They shrink. Why? Because exponential growth slows as assets scale. And now you've got global ETFs, institutional custody, derivatives market. The growth still exists, but there's no 10,000% growth anymore. Maybe 300% to 700%, which is still large. So is a 60% drop possible? Yes. Is it guaranteed? No. But this chart proves it's normal. It's okay. You're crossing the street. Look left, look right, and cross. Don't close your eyes and don't move. Black swans are rare, but powerful events. It could be a regulatory shock, a liquidity freeze, a major exchange failure. Think silver. Those events trigger cascading liquidation. That's how you get 60% drawdowns. So understanding extreme tail risk, that's the idea of the channel, the black swan, changes how you should invest. So this is not a bullish chart and it's not a bearish chart. It's an honest chart, right? It basically says Bitcoin has crushed investors, rewarded investors, destroyed overconfidence, and created wealth. So again, if you find this very helpful, don't miss future deep dives and become a member. Give us a like and join as a member if you want to get much more into the education. But the point is this. That is how institutions win over the retail investor. They scare the retail investor. The investors get out, they buy, and the market goes back up, and then they buy back again. How can we use a circle price movement to understand its current behavior? Well, Mayor, first of all, one thing I think what's important is we have to stop trying to predict. Okay, we're not in the predicting business. Why? Well, because you're not going to get it right every single time. You should be in the risk management business. The reason why people are not in the risk management business is because it's much harder to comprehend. It's easier to be in the prediction business. It's going to go up. Buy this app. Buy this product. Let me sell you an AI app that's going to go and trade for you and make you money. You need to understand risk management so that you have the confidence when you have something like that happening to say, you know what? I'm losing money, but I'm holding on. That's exactly what's happening. My members will know. I mean, Walsh and David out there know what I'm talking about. I had this position, a silver position, up 30%. And then I said, well, we're going to have a problem with silver. I mean, silver is going to go, well, wait. Well, guess what? It didn't go up. It went down because there was, silver went down not too long ago. It was like last week, 11% or so because the dollar was getting strong again and there were geopolitical issue coming down. So they said, you know what? We don't need silver anymore. But, right? So if you don't know what's going on, you say, oh my God, I could have made 30%. Now I'm down to plus 2%. Let me sell. I don't want to lose money on silver. Now it's at 14% today. But why am I able to go through the ups and the downs? Because I understand what's driving silver. I understand what's driving my asset. How do I know that, right? I didn't read it anywhere. I've learned and I've looked and I studied and I understand risk. And you have to do, and I'm doing the same thing for my members with Bitcoin, because Bitcoin is exactly the same thing. The thing is, obviously, silver, you kind of visualize silver. Gold, okay, I got gold, but Bitcoin, what is this? Where is it? My computer? Dollar, I could see, right? But no, this is a different world that we're living in. You better get used to it. Okay. I got to do this one on crypto as well, which is going to be well, I don't know if I want to do more crypto. Talk about the Q ratio. One of my subscribers was saying, I don't want to hear about anything. I want to know about the Q ratio. Okay. Let me show you what the Q ratio is. A very famous ratio that tells you basically it's been quite, I believe Warren Buffett uses it a lot, or used to. Okay. Let us take a look at the Q ratio. If you haven't heard about that one, I think this is really about the stock market most. You see it. Okay. What if I told you that there was one valuation measure that has been tracking stock market extremes since 1900? And it won 1929. It won before 1966. It won before 2000, and it won before 2008. And today, it is near the highest level ever recorded. Yes. Maybe now is the time to do tell hedge for portfolios. Been saying that for a while now. So that measure is called the Q ratio. So let me break it down to you step by step so you understand exactly what it means and why it matters. So we focus on education here, right? Not prediction. Focus on risk, not on hype. And if you want to go deeper, we're thinking about becoming a member so that it helps this type of research. And I will tag a Black Swan book again for you. All right, so let's take a look at the chart. Q ratio since the 1900s. And it's basically going to show you exactly, what the chart itself, and then you're going to see, I mean, I'm assuming by now you understand the bad period of history, but let's talk about it. So what is a Q ratio? It's a ratio. So the Q ratio compares the market value of corporate stocks divided by the net worth of those companies. And in simple terms, it compares what investors are willing to pay for companies to what those companies are actually worth on their balance sheet. Now, does this mean that the Q ratio causes the downturn? No, this is pure correlation, not causation, but it is pretty accurate. So think of it this way. If you bought a house for $1 million, but the brick, the land, the structure only was $500,000, you paid double the replacement value. Remember, we look at the market value of corporate stocks, basically the market cap, over the net worth of those companies. So notice the horizontal black line across the chart. 0.84. So historically, over 125 years, the market tends to trade near that level. Above it, stocks are expensive. Below it, stocks are cheap. It's simple, right? So let's walk through history with me. Look at 1929. Okay, so we are all the way to the beginning. In fact, I give you the ratio. I mean, corporate equity minus over corporate business net worth. Okay. And you could see that it rises to 1.06. And of course, that was before the Great Depression. And then look at the 30 and 40, the ratio collapses down near 0.3. Move forward, you look at the 60s, we spike again in the 60s, right? All the way to 1.73, we reach a new high. And then there was a nifty 50 right period where investors believed certain companies could never fall. They were wrong. And the market then went through a brutal decade of inflation and sideways movement. Now look at 1982. All the way down to 0.29. That was the beginning of one of the greatest bull markets in history. The greatest. And you move to 2000, and you will note that it did not record the 1987 stock market crash. I mean, there's a bit of a dip around 87, but then it kept on going. Then you move to 2000. So then you peak to 9 to 2000, a 1.47. Then you have 2008, the collapse again. Now look at the far right of the chart. We are near 2.0. Now this is the highest we've ever been now. This is higher than 1929, 1966. This is one of the most expensive readings in over a century. So what does it actually mean? It doesn't mean the market is going to crash tomorrow, because quite frankly, in 1987, we had a 20%. That was the worst stock market crash in history. And the Q ratio didn't pick it up that well, right? It didn't collapse. It kept on going higher. So doesn't mean it's going to be a crash, but when the ratio is high, long-term returns tends to be weak. If I tell you that the kind of return environment you're likely entering at 0.3, you're buying companies for pennies on the dollar. At 2.0, you're paying double their replacement cost. And over a long period, gravity tends to win. Why is it so high today? Well, I mean, there's massive liquidity over the past 15 years, ultra low interest rates for a long period, passive investment flows, concentration in mega cap technology stocks, investors paying a premium for growth. But here is a question. Are corporate assets truly worth double their book value, or are investors simply paying for hope? Because hope has a price, and history shows that when optimism reaches extreme, future returns compress. Now let's take a look at interest rates and Q. And don't forget, Q obviously was a Buffett Berkshire favorite. And by the way, he's out of the market for the past 2 years. Okay, so when interest rates are very low, investors are willing to pay more for stocks. That partly explains why valuations expanded after 2009. But today, rates are near zero. They are higher than they've ever been in over a decade. So the market is priced at near record valuation levels in a high rate environment. Because higher rates compete with stocks. That increased discount rate, that compressed multiples. What do you think happens when those rates go even higher? Because of inflation. In 2000s, investors believed that the internet changed everything. Profits didn't matter. Growth was permanent. Sound familiar? Today, the story is AI changes everything. Productivity will surge. Tech dominance is unstoppable. Now, AI may very well be transformative, but valuation still matters. The Q ratio doesn't care about narratives. It measures price versus underlying business value. And right now, that's all we hear. Narratives. Today, the market is doing better because they say, well, for the past couple of days, AI is too much. What are they doing? Too much money. Now they're saying, well, maybe it's a good thing after all. And the market is back up. It's pure narratives. And that talking to the children in the room, which is the retail investor. And they know well that the retail investor does not understand what is going on. Because the retail investor is focused on the prediction, not on the risk management. Markets tend to revert toward historical averages over time. That's what you call mean reversion. Everything goes back to the mean eventually. Statistically, although I will beg to differ, that you notice how every spike above 1.5 eventually comes back down. Not immediately, not gently, but eventually. So what could bring it down right now? Earnings disappointment. I mean, as soon as you talk about AI not being what they say there is, it starts to drop. Liquidity tightening. Right now, the new Fed chair is saying basically that I'm going to start tightening on liquidity. Recession, very unlikely. Although be careful, because if you have a huge amount of inflation and you keep lowering rates, the way you're going to stop it, you are going to do like in the 80s, you're going to raise interest rate again. That's going to cause recession, because that's, if it's what it takes to lower the inflation, that's what's going to happen. And this is what happened in 1980. Geopolitical shock. The US has two major ship in the Middle East right now, right? Aircraft carrier. They could do World War III down there. They're going to bring it back? Or do they want the pound of flesh out of Iran? How much do they want? You know who's negotiating, right? He's not going to let it go. He never lets it go. So what are the people going to do? Just, he wants them out, basically. And this is going to be very tight. Policy mistakes. Yeah, I mean, let's lower rates while we have inflation, because that's what I was hired for. A black swan event. I don't know, something that we haven't thought about. Remember, extreme valuations create fragility. And you've got this thing going on here. Take a look at the video that I did about the amount of treasury securities in Grand Cayman. Why is it over there? Huge amount of leverage. Look what's happening with silver. There's a huge amount of imbalances at COMEX right now regarding silver maturing February 27, 2026. Very soon, next week. So what should investor do? Right? This is not a financial advice. Just want to make it clear here. This is purely risk education. So when valuations are stretched, lower return expectations, increase selectivity, focus on quality balance sheets, consider diversification, understand downside scenario, don't panic, understand, right, what's going on. And the bigger lesson is markets move in long waves, right? In fact, I had a student that studied waves and literally he works for an ETF firm now, but he basically studied waves and predicting the stock market based on waves movement, believe it or not. Optimism builds and valuations expand. So we're in a confidence phase, and confidence can last, but extreme always carry risks. So Q ratio right now is flashing a clear message: caution. Easy gain may already be behind us. Risk management matters more than ever. Risk management. Don't forget to subscribe, like, and do all the things you're supposed to do to talk to the algorithm. SCOTUS, SCOTUS, Supreme Court of the United States. Yes, we haven't heard about that one, but that one could be a lot of damage, because I will tell you, if you look at the Supreme Court, even though they're mostly, Trump appointees, the Court of Appeal said, no, these tariffs are not legal. You're not, you don't have that kind of power. Hard to believe that the Supreme Court is going to say it's okay. Now, of course, even if they say that the tariffs are not legal, what do? You give the money back? That could have a major impact on the bond market, because all the money that's sitting at the Treasury would have to be sent back. I don't think they would do it. They're not going to send that money back. And frankly, the other countries will not accept it. To correctly study cycle waves in silver, we need a chart dating back to 221 BC. I have a chart on silver all the way down to, you know, the gold to ratio, the gold to silver ratio, all the way down to that. Okay, class. I think I don't wanna. Tomorrow's a work day, so. Using Microsoft will weather the software storm. You know, I think I did a video on the software. It's a bit of a mess right now.